Hey everyone, how you doing? Today we're talking a little bit about market cycles, specifically large long-term cycles like what the Etruscans called the 90-year cycle, to the 11-year cycle, to an annual market cycle, to the Monday, Tuesday, Wednesday, Thursday, Friday weekly cycle. We'll also touch upon a little bit about a daily cycle and first reversal and so on and so forth. So right now it is October 30th, 2020, approximately 91 years to the day, October 29th, 1929, when the stock market crashed because everyone and their uncle was investing in the stock market. And back then you could trade on 10 to 1 margin. So you could put up $1,000 and buy $10,000 worth of stock. Now there's a great video that was put out by Warrior Trading. I highly recommend it. It's about 20, 30 minutes long. Go out and check it out. He's got a really good history on exactly what happened. But basically, the Etruscans, who ruled the Roman area in Italy, 900 years before the Romans were there, they had what they called the Etruscan cycle. That was a 90-year cycle. And the thought was that it was 4 generations, and it took 4 generations to move things a certain way, right? So the cycle was that every 22 and a half years, roughly, there was a new set of parents. And so 45 years, and if you double that to 90, you get 4 generations. So that's something interesting. We don't really trade on it that much, but it is kind of interesting that almost to the day, the market sold off this, it's in 1929, the market sell-off started in September of 1929. And if you look at approximately 90 years, it's 91 years, but approximately 90 years when the markets, came into sync, we sold off on September 1st. Also, in 1929, the market, really crashed and really started breaking support levels on October 29th, 1929. And if you look at October 29th, 2020, you get the same thing. I've spoke about the 11-year cycle, which actually sinks into 2009. March of 2009 was the nadir, or the bottom of the market, in March of 2009. And if you go 11 years plus 11 years to the future, you get to March of 2020. Currently, we're predicting the next 11-year cycle. It's tough to produce the 90-year or predict the 90-year cycle, but the next 11-year cycle will roughly be February or March of 2031. So we look at the 11-year cycle. This is something that I was taught by John Person, one of my mentors, one of the trading instructors. I went to several live trading and seminars, also about technical trading, algorithmic trading, so that you're programming your computer to do all the indicators and potentially trade off those indicators. He has a whole suite of software that he sells, but he's a great instructor, live trading, John Person, out of Chicago. It's personplanet.com, his website. But he always talked about the 11-year cycle. And if you look at, 1987, the crash, October 1987, add 11 years. 1998, what do you get? Long-term capital management and the Asian flu. There was an Asian flu out there, and there was a whole bunch of things that were related to industries in Southeast Asia. But basically, the market had a dip in 1998. And if you go 11 years plus 1998, what do you get? 2009. And then if you go 11 years plus 2009, what do you get? 2020, which has been perhaps the worst, crash, the most severe crash in March of 2020 in human history, really. So computers are selling things these days. The market crashes very quickly. We were in cash going into the new year for a variety of reasons, which I explain in an upcoming movie called The Algo Investor. It's coming out soon. We're just putting the final touches on it. It should be a fun film. It's a little bit of a trading adventure film. Let's just call it that. It's about 20 or 30 minutes long, and it's an actual true story. What happened to me, where in the beginning of the year, I turned $20,000 into $108,000. It was over like a 400% return with 2 trades inside of 45 days. So it was an amazing experience, and I wanted to share it with people so that they could see that, hey, I can do this too, And you don't have to be a day trader. In there every day, we don't recommend day trading. In fact, we say DDT, don't day trade. Use the algorithms. This stuff is becoming available. We're in beta, so we're going to be making iTraderPro.co 2.0 available to everyone out there. So if we're talking about the 11-year cycle, if you take, again, the bird's eye view from the 90-year Etruscan cycle down to the 11-year cycle, now we're down from the 11-year cycle. Let's just take a look at 1 year. So a 1 year cycle really starts in January. And what we have in January is it's known as around the third week of January, which is just incidentally Martin Luther King Day. Typically, there's market volatility. It's statistically one of the most volatile days of the year. And one of the reasons is because we're coming into a new year. Hedge funds may have sold off and have continued their selling through the fall of the previous year to capture those gains, right? Another reason is that most big Chinese hedge funds liquidate before Chinese New Year, which usually comes in February or maybe late January. So a lot of times there's just a lot of selling and a lot of volatility in January. So we always look at January as kind of like a red month. We just look, okay, January, don't be going long. February, we start getting prices that maybe are a little bit more, maybe P&E's, price to sales, price to EPS comes down. So we look at, maybe buying in February or March. And we always look at, I grew up growing stuff in a garden. My mom made me work in a very large garden. It was always almost like a mini farm. Like a cultivar, essentially. But, growing up in the New York zone where you have 4 distinct seasons, and, when you farm stuff, you put the corn or the tomatoes or whatever you're growing in the ground, you put it in the ground in March. So you're essentially going long agricultural, futures in March, right? Same thing with the stock market. So like John Person said in one of his courses, the only time to really be long the S&P is in February, March. So he would always be like, well, learn to trade some of these other things. I mean, if you want to become a live trader, there are other things to trade: the metals, gold, silver, cattle, oil, corn. There's all different commodities to trade. Options, obviously derivatives, and now there's cryptocurrency. So there's many other things to trade. But a lot of people are on Robinhood out there without really having technical indicators derived from candlesticks and that are predictive, not looking in the rearview mirror. So we're looking at releasing iTraderPro.co for the public in a very simple three-tiered, pay as you go. You can pay for it for a month or get the year discount or whatever, but it's not going to be like, oh, we have to have, 30 grand or 25 grand in an account with, paying $100 a month to get all these, access to these indicators, most of which you really don't need. There's only a few things to show, when the market's reversing. Wall Street is traded by computer. That people say, is the market rigged? Well, it's not really rigged, it's programmed, and a lot of the stuff, the cycles, the market cycles, 11-year, I'm sure this 1929 cycle had something to do with it. I mean, it's now Friday, October 30th, 2020, and yesterday was Thursday, basically the 29th of October. That's the 91-year anniversary of the great stock market crash. Now, you got to look at things with a crayon versus a fine point in terms of these, annual and cycles. Sometimes they slip out by a few months, but they are pretty accurate, and especially since the 80s and the 90s when real computer trading really kicked in. I mean, remember, when I had dinner with John and Pete Nigerian and their crew with the students out in Miami, I actually sat next to him, and he was telling me that back in the day, not only could you get fined for punching somebody in the trading pits, but you also, in the very early days of trading, you were not allowed to bring a computer onto the trading floor. You couldn't just have a tablet in your hand and buying and selling. That was an unfair advantage, So things have evolved to the point where everyone's trading for free, no commission, on their phone. It reminds me of 1929 when everyone and their uncle was kind of in the stock market, or the dot-com boom in 1999. So we're starting to see these sell-off points. I would say don't get caught grabbing a falling knife. Don't try to, buy now. Buy, look at the annual cycle. Like I'm saying, February and March are really the long season for buying stock in the S&P. If you bought Apple, let's say, in March of this year at 230, we bought it at 220, we had a 220 handle. So if you bought Apple at 200 or 230 or whatever it went down to, I believe it went down to very low. I think we had 239 or something like that. It went all the way up to 500 in the same year, in the worst, economy really in decades. So after, February and March, the long cycle, you have May. And there's an old expression, sell in May and go away. So always be wary. If the market's been really frothy, a lot of times people will sell in May. I think this had to do a little bit more with the fact that New York and Chicago trading floors are, if you've ever been on Wall Street in August, it's a lot of people take off for the summers. All of Europe, especially French companies in August, vacate. So if you sell in May, you're selling into the summer, you're fading your positions into the summer. But typically we look at this as a light volume time. I think now that things are 24/7, it takes news 41 seconds to fly around the world on Twitter. So it used to be the 24-hour news cycle, and now it's a 41 seconds. So in less than a minute, you have a news cycle that could just bomb your position in the middle of trading. Or so you always have to have your stops in and take advantage of these annual cycles, annual and 11-year cycles. We've done very well this year actually because of all of that, and because of just slowly taking positions, maybe a few per month, and doing algorithmic trading. In other words, we only take positions from the computer and then we enter them into our main trading account. We also use stops, sometimes puts, to hedge against stock positions and things like that. But for the most part, we're only looking at high percentage trades, and then we enter them and usually manage one at a time, really one or two trades at a time. We're not fully invested at this point because the market is so high. So we're in October, right? So you have May, sell in May, go away. You have June, July. There's some activity there. Usually it's low. Sometimes you can get good moves in independent stocks, but usually June, July, August are usually slow months. Now we come into September, the market picks up, and look at exactly what happened this year. We, as soon as Apple and Tesla on March 31st, 2020 did their splits, Apple did a 4-to-1 split, Tesla did a 5-to-1 split. That was August 31st. That was essentially the high of the market. I believe Apple had traded up to $530 a share, up $300 a share. I mean, it's up more than 100% in a year. And now they come out, this week on Thursday, which was the 29th. All the tech companies came out Thursday, the 29th of October, and announced, there's a little, maybe there's some soft sales. Well, yeah, not everyone's rushing out to buy a $1,200 brand new iPhone when the iPhone 11 is pretty damn good. And people are out of work, yes, tech, whatever, survived. But if you look at most businesses, I just came back from an international trip where you see there's just no business. I mean, it went to zero. So I think there are some, cold months coming. But continuing with the annual cycle, once you come out of the summer, August into September, you get a lot of high action in September. A lot of traders are trading between September and Thanksgiving, which is November 24th, typically. And if you look at this year, you have September, which reached, all-time high September 1st, and then immediately from September 1st, it had just been a sell season all the way down. So typically things start selling off in October. I believe this year the cycle was advanced 1 month just because of the extreme run-up in the market, the extreme, price to sales. I believe on Apple is 1 to 8, price to earnings. On Tesla is, over 100. Price to earnings on Amazon today is 123. That means it would take you, if you had $1 billion and your price essentially it's the number of years it would take to pay off that company, right? So if you bought it, so 123 is a huge PE. I mean, 30, 40, 50, 28, those are high PEs for tech companies. But if you look at Amazon, I mean, yes, I know they've been extremely active with COVID, but it's a time of irrational exuberance, I believe, where the market has been dislocated from reality. So if we look at the end of the year, we look at, coming into, again, September, high volume. A lot of big trading companies are going. They just happen to be short this year and start selling all their stuff because who knows what's coming. We have an election year. And into October, typically October is a sell-off year. We tell friends and family, do not start buying in October or November. Sometimes you can get a sell-off down into November, balancing into December, and they have what's called the Santa Claus rally. And actually, if you look at, December 2018, like literally to the day, the market sold off in late December 2018, as is expected, sort of selling off into the end of the year. And on December 26th, 2018, you can look at the market at a local bottom, and just rock it up. So I think I remember buying calls on Amazon, and there were 1,400. Amazon was trading about 1,400, 1,500. It got slammed, and immediately it sprung back to 1,700, 1,800, 1,600, something like that. But in just a few trading days. And I remember that, specifically, that was the Santa Claus rally in effect. December 26th, 2018. If you look at it closely, there is an exact, to the day Santa Claus rally. So if we're rallying or short covering into late December on light volume into the holidays where no one's really paying attention, or, there's especially in the retail market space, it's sort of like people aren't really day trading over Christmas, right? So typically in the annual cycle, just to wrap up, we basically have a rise at the end of December into January, and then January being left, hey, now we're in a new year. A lot of times, again, with the Martin Luther King Day coming up in the third week of January, where the U.S. markets are closed that Monday, but Europe and Asia are open, creates some dislocation and sometimes volatility. Again, it's statistically, around that week around Martin Luther King Day is statistically very volatile. In addition, going, up into the end of December, you're coming in high in January, and then you've got every Chinese hedge fund in January selling off. So that's also going to, give you pressure on internationally exposed ETFs and things like that. So the market typically will go down January, February. You'll hear of sell-offs in February. March, things, maybe a couple of weeks later. March is typically a good time to start buying and buying stocks for the year. So that's really it for the annual cycle. And as far as Monday, Tuesday, Wednesday, Thursday, Friday, there's a great book called Sniper Trading by George Angel, and he exemplifies this in not only examples, but in these charts where they looked at from 1990 to 2002, I believe. They took that bull market, and they took every, from when the market opened 9:30 a.m. New York time, 10 o'clock, 10:30 a.m., 11 o'clock, 11:30. Every half hour they took data points for 12 years, and they put those into essentially an averaged graph. And you see that on Monday, the cycle is that people in a bull market buy up until about lunchtime, and then there's a little sell-off, and then you see people come back from lunch and okay, everything's okay. So there's typically they'll be buying in the late afternoon. Tuesday, they call it short covering day, or a late day rally day, late day Tuesday rally day. A lot of times the market is trading plus or minus just a small, very small moves in the morning, and you'll see this big move come in around 2 o'clock in the afternoon, and it'll be to the upside, because anything that's been sold off, especially if the market's been sold off for a week or two, you'll see in the coming weeks after the election, things get balanced out. You'll see a short covering like you wouldn't believe on a Tuesday afternoon. Now, Wednesday is typically choppy, and again, looking at this graph that George Angel, put in his book. These are extracts from his book. And we've done, anyone with a trading computer can run, historicals on a 30-minute chart. And you can see that a lot of times this stuff does really take effect. And also trading computers are programmed in a way to go long early Monday morning and, put the stops in, and et cetera, et cetera. So, we come to Wednesday. Wednesday is typically a choppy trading day. It's choppy in that it's usually up, in the morning, and then all of a sudden around 10:30 or so we start selling off. Maybe it goes back up till in the midday and comes back down in the afternoon. It's very choppy. Typically, if we're trying to enter or exit a position, we really don't trade or enter established positions on a Wednesday. We will look at starting, and we will look at implied volatility for options that week, the next week, etc. on a Wednesday. Thursday typically is a late sell-off. So a lot of times in a bull market, a Thursday, you'll get highs on Thursday, and then right around 1 or 2, usually around 2 p.m. New York time, 11 a.m. Pacific time, the market sells off. Sometimes there's a short covering rally in the last hour of Thursday, but typically we'll see on Thursday a sharp decrease in price, a decline, a sell-off in late Thursday afternoon. And sometimes we see a short covering rally coming into the end of Thursday and up into Friday. And when we go up into Friday, we open Friday, typically highs are usually around 10 or 10:30 in the morning. Usually by 10 or 10:15 in the morning on a Friday, in a bull market, the market starts to fade, the market starts to sell off. And that sell-off will happen all the way through, and it'll bounce around. Fridays usually, it's options expiration day every week now. It used to be every third Friday of the month. Now it's every Friday. So Fridays typically, we traded, for example, it's Friday, October 30th today. We traded in the morning. Peloton has been just, slammed. I don't know how many people are buying $2,500 bikes when there's literally, the economy is in such bad shape. I don't know the specifics on them. I just know that they got heavily downgraded, and our technicals gave a sell signal, and all of the technicals kept us in the trade. So we basically have been, buying the puts on Peloton, and that's exactly what we did this morning. I think we did a quick $1,000 or something, literally in one trade. By the time you enter the trade, the market slides off, and your base limit order is already triggered, and you're up 20%. So we're trading very small positions, but it's a way to take advantage of the volatility out there and make money. So typically Friday is a heavy sell-off in the morning, especially if the market has gapped up to some kind of high in the morning on Friday. That gap will usually be faded and closed. It'll sell off, and that market will close that gap on Friday. And typically, we look at around 2:30 in the afternoon, Friday, New York time, to start essentially establishing a long position for stock if we're going long over the weekend, and it looks appropriate. But pretty much that's the Monday, Tuesday, Wednesday, Thursday, Friday cycle. And again, you can look at George Angel's book called Sniper Trading. He's got a great chapter on the entire cycle and the psychology behind it, because all of these moves are really psychological and based on a weekly trading pattern. In addition, there are 3-day bull rising and bear falling, if you will, patterns. They're candlestick patterns. It's called 3 bulls rising. A lot of times the opposite is obviously with red candlesticks, but typically if a stock breaks out, you'll see it break out a big green candlestick on day 1, another big green candlestick on day 2, and then another one that's maybe not so big on day 3 as the market starts to say, okay, we've reached these highs. The market's up so much in 3 days in this one particular stock or this one particular commodity, and that'll typically create a 3-day cycle of a 3 bulls rising, as the Japanese candlesticks call it. As far as the daily cycle, typically, like I said, it's almost like a Friday morning, right? There's usually a reversal if you're day trading. If you have the money to day trade and also you want to do that, typically, the morning is a reversal between 10 and 10:30. I mean, if the market just shoots up, all of a sudden you'll see around 10 o'clock in the morning, New York time, or 10:15 or 10:30, somewhere in there, there'll be a reversal. And the market will sell off. And then again, typically, after lunch, there's another cycle. So usually there's 2 cycles per day. But again, you have to look at the buy and sell signals, which are triggering in an intraday chart. So that's pretty much it for the market cycles. Again, to review, we have a 90-year Etruscan cycle, which is based on 22.5-year generation. So 22.5 times 2 is 45. 45 times 2 is 90. That's a 4-generation, 90-year Etruscan cycle. We just hit a 91-year market sell-off like to the T. That's why I bring that up. Then we have the 11-year cycle. Every 11 years, there's essentially some kind of market crisis, whether it's savings and loan.com, mortgage crisis, bailout, COVID, you name it. Every 11 years. I didn't believe it until I saw it and started really digging into the research. But if you go, especially from 1987 forward, when computers were really integral into trading. I mean, people were trading in the 60s and 50s, but they weren't really trading with computers and all this kind of stuff. So if you look at really from the 87 crash forward, the 11-year cycle is really significant. 87, October crash. 98, long-term management. 2009, mortgage crisis. 2020, sure, it's COVID, but again, a sell-off where there's a transfer in wealth from retail traders and everyone else to the elite, and that's basically what happens. So the 11-year cycle is very important. We believe that the next stock market, the big dislocation, the big sell-off will be sometime in 2031, March of 2031. That's 11 years after 2020. After the 11-year cycle, you've got that 1-year cycle, the annual cycle, which if you just think about growing corn or tomatoes or whatever is in your farm, you plant stuff in the spring and you typically sell it in the fall. Stocks are no different, especially with hedge funds and being LPs and LLCs where they have a fiscal year end of 12/31, which is the same as a normal individual. So typically billions of dollars of hedge fund, if you're selling off Apple right now, it takes, and you hold $1 billion position in Apple, you can't just sell that in one day. So it takes a number of weeks to unwind. That's why the annual cycle is so important, especially towards the end of the year. After the annual cycle, we have the weekly cycle, and the Monday, Tuesday, Wednesday, Thursday, Friday. I spoke about George Angel's book, Sniper Trading. And after the weekly cycle, obviously, there's the daily or intraday cycle, which really depends on the day of the week. All right, folks, that's it. Stay safe out there. Hope you're well. Happy Halloween.